When institutional capital exits a position, the liquidation often happens in a sudden, heavy cascade that reshapes the valuation landscape in days. This data table for Infosys shows the impact. By late March 2026, the stock's year-to-date performance had dropped nearly 21%. This candlestick chart shows the price action. In early February, the price collapsed through support levels, leaving a massive gap as sellers overwhelmed buyers. Volume indicators confirm the trend, showing heavy, sustained spikes in red volume bars. A chart profile like this indicates a severe structural breakdown. An analyst observing this price action would investigate whether the core business model is beginning to decay. However, corporate filings from this period tell a different story. While the stock was selling off, the company was securing major enterprise contracts. On March 25, 2026, Infosys announced the deployment of its Finacle core banking solution for Producers Savings Bank in the Philippines. The bank uses this platform to scale its digital lending operations for small and medium enterprises. One day earlier, they extended a collaboration with the University of Nottingham. This deal uses Infosys Cobalt and the Topaz AI Fabric to manage data and student information for 46,000 students. These deep software integrations embed Infosys into the core operations of global institutions. Once installed, the complexity of these systems creates incredibly high switching costs. Cross-examining this market repricing against the company's actual operations allows us to determine if the sell-off aligns with the underlying financial data. To understand the situation, we must isolate the raw financial output of the company from the current market sentiment. Data shows for the period ending December 2025, Infosys generated 37,996 crore in revenue. In the same column, operating profit margin sits at 27.11%. This tracks revenue remaining after variable costs, serving as a direct indicator of efficiency. Maintaining an operating margin above 27% protects the company's cash flow. Even when macroeconomic headwinds force a stock price down, a margin this wide ensures the business remains profitable. The financial engine is intact. The question is how Infosys maintains these high margins while the stock chart breaks down. The answer lies in their revenue structure. Infosys does not rely solely on lower-margin hourly consulting. They deploy proprietary, integrated software-as-a-service platforms. The Finacle ecosystem uses an API layer to connect lending platforms directly to a bank's core system, automating client onboarding. Similarly, the Nottingham University contract utilizes Topaz, a multi-layer AI fabric unifying disparate legacy systems into a single data pipeline. The operational impact is quantifiable. The Nottingham deployment resulted in a 70% reduction in incident volumes and cut infrastructure costs by 35%. Once an institution integrates these platforms to achieve those savings, decoupling the software requires a complete overhaul of their core operational workflows. Delivering these measurable cost and error reductions creates high switching costs. Clients become dependent on the ecosystem, which secures the long-term margin stability seen on the balance sheet. A robust operational model does not grant immunity from systemic market repricing, but it does provide a floor for valuation. As the stock consolidates around the 1,289 level, the percentage of deliverable quantity to traded quantity sits at 35.76. The delivery ratio measures how many shares are bought and held in accounts versus those traded intraday. A ratio near 36% suggests institutional accumulation rather than speculative day trading. We can also check the RSI, or Relative Strength Index, a momentum oscillator that measures the speed of price movements. In the subchart at the bottom, the RSI line is curling upward, attempting to find a floor after the steep drop. The technicals indicate the selling pressure has likely exhausted itself. Capital is stepping in to price the stock based on the steady-state operations we analyzed. An analysis of Infosys in March 2026 reveals a company operating on two completely conflicting timelines. In the short term, the market has handed down a punishing year-to-date adjustment and inflicted clear chart damage. However, looking at the 10-year horizon on this analytics table reveals a 113% positive change. Long-term resilience is anchored by the deep enterprise integrations and proprietary platforms that secure 27% margins. The noise of the daily ticker often masks the quiet, relentless compounding of embedded B2B technology. While the technical chart dictates near-term caution, the underlying enterprise architecture continues to execute a margin-rich strategy that the market will likely eventually recognize.